As I was introduced, my name is Omar Vajeth. I head the Power and Energy, Power Utilities and Infrastructure area within ABSA Capital. We are part of the Barclays Group, majority owned by Barclays, and we are busy going through a process of renaming ourselves to Barclays Africa Limited. Let me just say that it's been a fantastic year for power projects in the region. We'll be closing more deals this year than we ever had. Close on to 32 projects will be closing or have closed this year. And this is a phenomenal achievement for the region. This includes the renewable projects in South Africa, projects in Kenya, and projects in Ghana and other places. I think the sector is really growing, and the understanding of how to do these power sector deals is growing rapidly as well. I'm very fortunate to have amongst Lenders Council who helped us on the project, Greg from Fulbright and Norton Rose now. Veronique also is part of the team for the IFC, and Shamali as well from MEGA. I think all the lawyers that are present here, the influence and the knowledge that was gained and shared through these projects is helping us all grow in the region as well. And they'll very ably support me, I guess, through any technical questions. Laurencia has set the context for Kenya, and let me just say that it's a long way to go. There's not a lot of power in the region. In Kenya, you're looking at close to 1,600 megawatts, and you're looking at a population of 30 million people, Laurencia. And I think for places like Kenya, Uganda, Tanzania, you're looking at thousands of megawatts to go into these networks. But the understanding of the legal frameworks, with Kenya leading the way now in terms of closing deals in East Africa, is, as I said, growing rapidly. And with the sharing of this knowledge and how to structure these deals, we are expecting a phenomenal growth in the region. I have put out a few numbers, and according to the least cost plan that Kenya does have in place already. And I'm just focusing on one project for this presentation, which is the Thika power project. It is a project that had all these elements that Laurencia spoke about, the PRG, the MEGA structures, and most importantly, what these structures do is it allows for commercial banks to participate. And you'll find in the project finance space globally, it's not an art that is performed by many in the world right now. The South African banks, from a commercial bank perspective, are very active in the space. And we are in the whole, South-South participation in all of these. It makes sense for us to be participating in project financing deals. The biggest issue we face as a commercial bank is around Basel and regulatory pressures and whether we can lend long tenor on these deals. And this deal, for example, allowed us, because of the structure and the legal framework, it allows us to lend for 15-year money, which is quite an achievement for a commercial bank. So the project is basically an 87 megawatt heavy fuel oil project, and it's not renewable, it's not clean burning, but in the case of Kenya, this is an option they have to pursue. They do not have the baseload power plants that can keep the lights on in the country, and these heavy fuel oil projects allow for some sort of sustainable power for the long term. But they are developing geothermal and wind to complement these more non-clean fuel sources. Malik is a sponsor out of Lebanon. This also shows the growing interest in Africa, because we are attracting because of the stability in the region and the legal frameworks. We are attracting investors from across the globe. It's not just China. It's not just Europe or the US, but places like Lebanon. And also we're attracting investors from within the region as well. there are some projects being purely sponsored by local sponsors within the region. 112 million euros, limited recourse, 75-25 capital structure, 20-year PPA. And one of the key things that we do have is this letter of support that Laurencia highlighted. One of the challenges we are facing in the region is governments pushing back on giving us the sovereign guarantees that we require for these long tenor deals. And the letter of support that Kenya has is an interesting way to we don't call it a guarantee, but it gives gives us the comfort that government has taken on a lot of obligations for political force majeure and termination as a result. And that we can get covered, as long as we have those sort of support structures. And I guess one of the things we need to get out there, and especially in our markets, is that even though governments do not, and it's understood that infrastructure will constrain governments for a long time in terms of cash resources, and contingent liabilities are something they've got to manage. They still do have to take on obligations. Things like political force majeure has to be taken by governments. And issues like currency devaluation and currency issues are deal breakers for a lot of us. And governments need to realize that these things have to be covered. This deal is interesting because it allows a commercial bank to participate. It's not just development institutions and donor funding, and it is a fully commercially well-structured deal that stands on its own from a bankability and credit perspective. And in the Barclays world, to lend is not an easy task. It's a process to get deals through a credit committee, and we're talking about global credit committees. And this deal has stood out, withstood very detailed analysis from the Barclays world. Kenya does have a track record, as Laurencia highlighted. This gives us a lot of comfort. There's KPLC in any other country would have been able to do this without a lot of these credit enhancements that we're asking for, and this political force majeure termination type guarantees that we're asking for. If you take KPLC and KenGen on their own, they are very credit-worthy entities. It's other issues that are causing us to not be able to lend directly to these well-run and well-managed institutions. And I think that's an important point. If we try to use these structures on entities that do not have, on its own, ability to sustain cash flows, or does not stack up from a credit perspective, it'll be very difficult to do these things. So whatever we do, we're still looking at the underlying credit of the entity and the ability for that entity to pay. The regulator, as Laurencia pointed out as well, is very transparent and independent in Kenya. And again, from a regulatory perspective, this gives us a lot of comfort. The risk allocation, we're not going to, I've got a bit of a table at the end here that gives you some indications of some of the risk, but we believe that the risk is appropriately allocated, and we spent a lot of time in this deal to make sure, and it's quite heated negotiations, but just getting that right requires experience, and especially from the legal fraternity, people who understand that certain risks can only be borne by certain people. And one of the most important things is the off-taker being able to accept this, and the government being able to accept this. And in Kenya, we're fortunate enough that the government does understand that certain risks they have to bear, and KPLC understands this as well. Again, this is supported by a sponsor who has done projects in the region. There's banks involved from the region, and that does help us with the the regional development. It is part of the least cost power, and HFO, I know if anyone understands, it is expensive power, and the fuel is not cheap, and it's not the cleanest, but it is a solution for Kenya, and it is a solution that will last for a long time. Just to highlight the deal structure, there's a lot of agreements and a lot of things that go behind this, but just the two key points. For liquidity, liquidity is supported through the LC structure that the IDA provided. And again, this is supported by a creditworthy off-taker, and that is one point. The other point is the termination cover that we get out of MEGA. And with these two, it allows us to basically get this deal banked. I'm not going to go through all of this. This is a lot of detail. We put this in just to highlight that there's a lot of complexity, and I don't expect you to read, but I'm sure Patricia will distribute it. And two key points: political force majeure is covered. We also managed to cover the PPA under the MEGA breach of contract as well, and specifically that helps us with devaluation. And very good structure, and encourage you to have a look at it. And we are planning to use this sort of structure in various jurisdictions. As a bank, we are working in projects across the region: Zambia, Mozambique, Namibia, and this solution and this structure does work in many countries. Thank you very much.